Ms. Eversole, the word of the day in Washington is affordability and making life easier for the American people by lowering the cost of living. How can regulatory tailoring and enhancing U.S. bank competitiveness through right-sizing the capital framework lower the cost of capital and help lower the cost of living for Americans?
Mr. Chairman, thank you very much. Affordability is a huge issue. And I think when it relates to bank capital, one size doesn't fit all. And so we have a sophisticated system, in fact, the best, most highly liquid, vibrant capital markets in the world, and we have the ability to make sure that we get it right. And I appreciate the fact that this hearing has happened today. The Basel III Endgame, making sure we get that right is a perfect example. If we can get that done, the impacts go to small businesses, Main Street, through lower cost of borrowing, and that helps drive the economy.
Getting this wrong and over-regulation of the banking sector will drive up the cost of credit, period. That is a simple and absolutely true fact, and that's why we've got to get this right. Mr. Flood, miscalibrated capital rules are extremely burdensome on small institutions that keep credit flowing to Main Street America. Community and regional banks are often the only lenders serving rural towns, family farms, small manufacturers, and first-time homebuyers. What are the downstream effects of inflated risk weights under the Biden administration's Basel III Endgame that would affect community and regional banks' ability to provide mortgages, agricultural loans, and small business credit?
Thank you for the question. Mr. Barr, when we surveyed those 300 corporate treasurers, we found that most small businesses use banks for their financing. They use an average of 4 banks. And I think you can see from our analysis the amount of banks in the country is decreasing. So the simple answer is, A, your constituents will either see increased costs or lack of availability of credit at banks. Third, we also know that increased compliance costs affect every bank. And we've seen how that has led to consolidation at the lowest levels. And finally, community banks like to replenish their capital. How do they do that? They sell loans or products to bigger banks. If those bigger banks have increased costs or increased risk weights for those same products, they're going to charge more to your smaller bank. So there's a downstream effect.
Yeah, this is trickle-down regulation. It's not just about the big banks, it's about community banks and making sure that the capital framework does not inadvertently shrink access to credit in underserved markets. Ms. Tyre, in 2023, when the Vice Chair Barr, the other Barr, proposed the Basel III Endgame, it received bipartisan and nearly universal criticism from lawmakers and the public. In fact, more than 97% of the comments on the proposal were negative, with more than 80% of those comments submitted by interested parties outside of the banking sector. The message was clear that we needed a reproposed endgame. But even under the reproposed endgame, the expectation is that U.S. banks will face materially higher risk-weighted assets from revised credit, market, and operational risk frameworks. Yet the leverage ratio remains unchanged, which creates a potential for double counting of capital requirements. How should regulators appropriately account for reforms to Basel III Endgame to ensure that bank leverage ratios do not bind institutions during low-risk, high-liquidity environments?
Double counting is a real issue, Chairman Barr, and I'm glad you asked the question. I think what happened in 2023 is that the banking regulators did not do a bottoms-up data-driven analysis. And currently, it's a bottom-up data-driven analysis that is being promised by the banking regulators. The leverage ratio became the binding constraint as Treasury markets expanded, given the fiscal situation. And my own view is that there should be a real rethink of the leverage ratio, which affects, as you know, not just the biggest banks, but all of the banks.
Thank you. Mr. Ullman, final question. As you know, Fed Vice Chair of Supervision Michelle Bowman has said that the regulatory thresholds should not be static, and FDIC Acting Chair Travis Hill recently finalized a rule that seeks to index regulatory thresholds on a biennial basis. I have introduced legislation, the TIER Act, to ensure that our regulatory system isn't static and that it's designed with growth in mind, which while maintaining safety and soundness. Can you please speak to the importance of indexing regulatory thresholds and how this will help ensure banks are holding appropriate capital that accurately corresponds with their size, risk, and scope of activities?
Thank you for that question, Mr. Chairman Barr. Put simply, if we don't index the thresholds, eventually we won't have tailoring, because over time inflation will move institutions into higher and higher categories. Already since 2019, when the categories were adopted, we've seen inflation run at about 25%. Nominal GDP is up 30%. That already is threatening to put institutions into higher categories simply because of nominal changes in the economy.
Thank you. My time has expired, but I'll just note for the record that when Dr. Foster and I traveled to Basel, Switzerland, it was interesting to hear the Basel Committee themselves say that former Vice Chair Barr's proposal had gold-plated American capital requirements over and above what they recommended. With that,